All right. Okay. So we'll get into it. So Clint, thank you very much for taking the time out today to obviously come and speak to myself and my clients in regards to what's going on in the world and how it's impacting our clients. We'll discuss a few things that are probably topical at the moment. So before we get started though, Clint, if you could just give a brief intro kind of into who you are and what you do.
Sure. Thank you for having me along. So I sit as part of Morningstar Investment Management's, the actual investment management team. So sitting on the committees that makes the asset allocation decisions on how we position our portfolios and the underlying investment selection and portfolio construction decisions.
Okay, awesome. And obviously, how can I say this? These are clients, the resources that we use to help build investment portfolios for you. Instead of kind of building it ourselves, we team up with the team like Morningstar, and Morningstar essentially work with us to make sure that your investments are trying to be at the right place at the right time. Okay, so when all these economic events are happening, we're either protecting your money in a certain way, or we're trying to reach some goals, and they're making sure that these investments are trying to reach those goals. So they keep us up to date with kind of everything that's going on. And what we try to do is make sure that they suit you individually. So what I'm going to do though is there's a few topics going on in the moment that are kind of hot topics for us, and I'm sure they are for you when you're sitting down at home, maybe enjoying a drink or watching the news. And one of them is definitely interest rates. The other one is there's a lot of doom and gloom on the news at the moment, so I just want to kind of work through that a little bit. There's the China and US trade war, which seems to be going on in the news nearly every day. And maybe Morningstar's view on some certain things that are happening around that. Brexit, and is that affecting us Aussies, and maybe how that's affecting the world. And maybe some tips or some things to think about out of this video will probably what we're trying to get out of today. So Clint, we'll kind of go into interest rates because they're probably the hottest topic at the moment. Most of my clients are speaking about a low interest rate environment that they've never experienced before, and they're right, because it's the lowest interest rate environment in history. How do you see this kind of going, and what's Morningstar taking out of this?
Yes, sure. So you are right. There's certainly plenty of things going on in the world. Interest rates is just one of those. Before we jump into some of those issues, let me just firstly say that we will talk about financial markets and investments, but for listeners, please don't take anything I say as personal advice or a recommendation to buy or sell anything. Obviously, John and his team are a much better place to perhaps apply some of the concepts that we're talking about today in the context of your own circumstances and objectives. But yes, you're right. Interest rates very much dominating headlines at the moment, and really, behind a lot of the rises and falls that we've seen in share and bond markets over the last little while. The challenge with interest rates is that they are extremely difficult to predict in the short and the medium term. And when we have if I consider where interest rates were at exactly a year ago today, so let's say, for ease of numbers, the end of September 2018, we had a feeling, or I guess a view from the central bankers around the world, that the era of ultra low interest rates was maybe coming to an end. The level of support from central banks was starting to be withdrawn as economies, particularly the US economy, was going quite well. There was no longer the need for those emergency level settings that really started out of the global financial crisis. And so the central bank was reasonably good at articulating that they were moving into a rising rate environment. And so one of the key measures that we look at is the 10-year bond yield for various countries. So what is the yield on a government bond of the respective country, as I said, the 10-year view. And so for the US, this time last year, it was around about 3.2%. And the Federal Reserve was suggesting that rates were going higher. Now, where it is at the moment is actually about half of that. And so that's a significant change. And it really reflects that the central bank has come out in support of investors once again, and really in recognition that maybe there's an increasing risk of US recession, although that's obviously very difficult to predict as well. And trying to give investors confidence that they stand ready to act. Now, in Australia, it's actually much more pronounced. So this time last year, we were looking at around a US 10-year bond yield of around 2.7%. We are now a third of that. So our 10-year bond yield is around 0.9% right at the moment. As you say, it's the lowest on record. And that is a really significant change. And it's really investors moving from expectations that the next rate move would be higher through neutral, and then actually it's going to be cut. And as you know, we've had a series of cuts since the federal election in May, and there's the potential for further cuts to come.
And it's very interesting because it quickly did change, and we only, like you said, we only had to look at the back half of last year where like you said, most central banks or most even experts were saying that central banks were going to start increasing, and it's quickly changed. And, that probably leads on to a bit of a segue in regards to obviously probably the Chinese and US trade war as well. And
yes,
what impacts that's having on confidence, both on business confidence and on consumer confidence.
Yes.
And is that weighing down on the sentiment around the world?
I think so, because it's uncertainty, and as investors, humans don't like uncertainty. But again, if you think about, I guess, maybe the flow of how the last year has gone, you might recall in the final quarter of 2018, we had quite a lot of volatility in share markets and actually bond markets. Mm-hmm. And so really what the concern was there is that the Federal Reserve were raising rates, and they were telling us that they were likely to raise rates in the future. Mm-hmm. And this happened at the same time as there was some worrying signals starting to come through around global growth. Mm-hmm. And obviously those two going together is not a good combination. And so when you look in the bond market at that time, there were some signals that maybe we were actually approaching a US recession, and it all disconnects. Mm-hmm. And so we saw huge volatility in share markets, down sort of 10 or 15%, most of the major regions were. Mm-hmm. And then around Christmas time, Federal Reserve again came out and said, actually, we're going to take a much softer approach. And since that time, as we've discussed there, the outlook is for cuts, mm-hmm. which is pretty much a complete reversal of their policy from a year ago. Mm-hmm. And so, that's been very a big boost for share markets over 2019. You're looking at sort of double-digit returns for most of those key share regions. Mm-hmm. But I mention that because you do have concerns around rising rates, which mm-hmm. typically slow growth. Mm-hmm. You did have concerns around global growth, which mm-hmm. Is still ebbing and flowing today. And then you overlay something that's really quite big, like these escalating trade wars, which just feel like that they've picked up in intensity a little bit recently. We obviously had the Chinese devalue the yuan, which mm-hmm. is potentially a significant move. Mm-hmm. And obviously, even in recent days, there's been further escalation in those trade negotiations. And the problem is, when you have that situation, it feels like a zero-sum game. So if Trump is able to make America great again, then someone has to lose. Mm-hmm. And there's a perception that it's those economies that export significantly. So you're looking at some of those emerging market countries like China, Korea, also Japan's not an emerging market country, but it's mm-hmm. certainly a huge exporting nation. And so, so sentiment.
I was actually going to say there's a view that's an interesting one, that both China and the US will both win out of this.
Right?
It's one of those ones that, yes, there's a lot of uncertainty at the moment. That there's kind of the is it going to pan out? Is it going to pan out? And the two biggest economies in the world, you would think that they're going to possibly come to an agreement.
Yes.
But the agreement, I would possibly think, and this is my personal opinion, for both of their economies, they're probably going to try and do it for a win-win for both.
Yes.
And Donald Trump, as we know, is a very good negotiator, but
yes.
he probably understands that if he has China winning as well, he's going to even supercharge that "Make America Great Again."
Yes.
He does need them in some capacity. So it is the uncertainty that people are talking about. But it would be very, very shocking to see, I believe, a complete loss on one party and a win on another. It'd be hard to see that.
Yes, and I think you highlight a very good point, and it's actually applicable to interest rates as well, and perhaps some of the other things that we'll talk about today. And it is that when uncertainty comes, it's because invariably there's quite a wide range of situations, possibilities, and some of those are quite dire. And the human, nature, the psychology tends to point us towards those more dire outcomes. And so if we think about trade wars, yes, there is a scenario that says actually it's going to be win-win, and investors around the world and businesses will take confidence from that and invest and grow. And at the other end of the spectrum, there is a scenario where both lose, and then there's everything in between.
Yeah.
And so this is the way that, we'll talk about Brexit, arguably the same situations happening there. With interest rates, there's actually a possibility that rates will rise. There's a possibility that rates will fall. And there's, quite a range of potential situations that will flow on from that. And Buffett has a pretty useful framework for looking at this sort of stuff. He says that when you're looking at these type of events, you can basically draw a simple matrix which has knowable and unknowable across the top, and important and unimportant down the side. And obviously you don't really want to focus on things that are unimportant, but I would suggest that a lot of those things that we're talking about today, like trade wars, they fall into the very important category, but they can't be predicted. And so we need to think a little bit differently around how we invest, because trying to predict those events, A, is very hard to do, and B, doesn't actually lead you to an investment decision based on.
So with all this uncertainty kind of going on in the market, we've seen, and clients have seen, this kind of lowering of expectation on total returns, let's call it. Yes. We've seen interest rates on cash accounts be dropped, bond yields and bond prices being not where they say were 15, 20 years ago. Especially in regards to equity markets, they have rallied, but, historically speaking, they're not where they used to be. And our view is that, this is going to be the new norm, this kind of lowering of expectations in regards to returns. But, in all of this, is there opportunities that maybe Morningstar are seeing that are coming? Is the traditional no longer kind of where we need to be looking, or where Morningstar is looking? Is there something that you guys can maybe say, what? This is actually doing not bad? Or what's your thoughts in regards to or what's Morningstar really maybe looking at?
Yes, absolutely. So you are right. We think we are in a lower returning part of the cycle. And what that's really saying is that we've had such a period of strength in both equity and bond markets. For those returns to be considered fair, we need to go through a period of more muted returns. So as the average is fair. And that, I guess, people listening will get that idea. If you're a farmer, you know that not every year is going to be a bumper year. You're going to go through, more lean times, and sadly our farmers are going through those at the moment. And so in good times, you need to keep a little bit away, tuck a bit away for the, the rainy days, they say, when times are a little bit more challenging. And that's the same type of idea in investment markets. We've gone through a very strong period for share and bond market returns. And when we look at what's in the price, and so I touched on, that Buffett framework before, where, some of these things are quite unpredictable. The way that we look at these events is to understand what's in the price. What are we getting compensated for? Are we getting fairly compensated? Or in the case of, many of the assets that we see at the moment, where returns aren't that attractive, the risk of loss is much more elevated. We need to be much more prudently positioned. And so what that looks like is that, share markets and bond markets generally, we would say, are quite expensive. If we think about some of the, the common market cap type benchmarks, be it US equities or Australian equities, in aggregate, they look quite expensive. And same for bonds. If we look at, the market index for bonds, we would say that's also quite expensive. And so what that means is that we need to get a little bit deeper. We need to do something a bit different to just standard index positioning, generally speaking, to try and deliver our investors a better return for the risk that they're taking. And interestingly, where the better opportunities come about is where uncertainty is prevailing. And it's that idea when we see that uncertainty and we don't like that as investors, it's a very natural human response to feel like that. We tend not to invest in those markets.
And I think that's where that professional kind of knowledge also comes from as well too. And
yes.
That that layer of active management really comes of value.
Yes.
In inefficient markets, it was only a month or so ago, I was at an investment conference, and they were talking about the Chinese market at the moment. It's really been subdued. Low interest rate environments. Not low interest rate environments. Sorry, low return environments in a lot of their industries. But yet there were certain sectors that were doing very well,
Yes.
And I think that level of knowledge and that level of attention probably needs to be looked at the moment. That scattergun approach. It's very, very hard to. How can I say it? I think get the best outcome. At the moment, because there is a lot of factors impacting, even from a sector, from a country, from an asset allocation or an asset class. There's a lot going on at the moment.
So I completely agree. Maybe the way to think about this is when markets are expensive, we need to turn over a few more rocks than normal to find some of those opportunities. And those opportunities, they might not be where you expect. For example, at the moment, the US share market is the biggest share market in the world, but it's actually something that we find quite unattractive. We have a much greater preference towards Japanese and UK shares. And so if you think about what's going on there, obviously Brexit is, well front of mind for UK investors. And that fear and uncertainty that Brexit will bring is actually creating the opportunity in that share market. So we're saying we don't know how Brexit is going to play out, but we think investors are getting compensated for a wide range of possible Brexit outcomes. And that is in our favour to invest. Now, again, with Japan, obviously trade wars are well underway, which is a bit like hanging like a cloud over that market. But when we actually dig deep and we're looking for attractively priced investments that are high quality, we can see some very encouraging trends in Japanese companies. We can see profit margins are expanding. We can see dividend payouts to investors are increasing. And they're really nice trends for us to be exposed to as shareholders when we're able to buy those assets at a good price.
So that probably brings us a little bit into maybe our next topic in regards to Brexit. And,
yes.
And we always are hearing in the headlines, it's going to be bad, it's going to be good. And we've talked already about, different views.
Yes.
But maybe what I want to talk about is what's the impact to Australians? Because, it feels like it's, right on the other side of the pond.
Yes.
And, is this actually impacting Aussies? Like, are we actually feeling this in any way? In any way. Yeah.
So it's a good question. It's perhaps, if we look at Australia's trading partners, then obviously we're very Asian facing. And so in that respect, if you think about the UK and Australia may well, sign ongoing trade arrangements. But I guess the real implication is, if the worst case scenario does happen for Brexit, what is the knock-on implication for Europe, potentially for global growth and certainly global sentiment? And that's really, really hard to predict because as you look at Brexit right now, and even overnight, I was reading articles around further developments. They may potentially look to go to an election on December 5, having kicked the can down the road numerous times already. And we simply don't know what that outcome is going to be.
And I would tend to say that the impact from Brexit is more indirect than direct for us. It's more of like you said, that kind of flow-on effect.
Yes.
It's not the direct, UK being here and Europe being here, and then all of a sudden Australia's in the middle.
That's right.
It's the global impact that has. And we can all see this kind of globalized world now. If we only look 30 years ago or 40 years ago, we weren't in that. me growing up in school, it was, the world turning globalized. And
yes, that's right.
We are living in that. So, it is a direct impact. It might not be as direct as, say, a Chinese impact to us.
Yes,
We
of
are
course.
so heavily linked.
That's right.
But it's probably more indirect, you would say, yeah?
Yes, but I would. But you raise a really good point, because one of the things that's worth observing about the UK share market is the UK share market is not the UK economy.
Mm.
And actually, if you have a look at the underlying constituents that make the top 100 of the UK share market, and particularly at the top end of that list, so the bigger companies, it's a who's who of global business. So most listeners would recognise the names of those companies, probably using their products on a daily basis, whether it's Shell to fill up your car, or some of the pharmaceutical manufacturers that are domiciled in the UK. And so they earn a significant amount of their revenue offshore. And then suddenly the pound is falling because of the Brexit uncertainty. As you bring those earnings back, it's kind of an earnings boost. That when you repatriate them, they're worth more in pounds than they were in the past.
And that's same for some Australian equities now. You have a look at the top 5 or top 10, and you have a look at BHP, and if you have to kind of look at where their earnings are.
Yes, and they do have that currency sensitivity.
Yeah. Clint, I think your video briefly dropped out. That's all
back,
good.
We're back. Yes.
We're back. So I think that Brexit does have its indirect impacts, and obviously, as your advisors, we keep an eye on things, as obviously Morningstar does. And
yes.
But the Chinese US, when you've got two economies kind of
butting heads,
yes. That's really the highlight at the moment, that is shifting markets essentially overnight. And I constantly talk about with clients about the Trump effect, and that's also has great effect for good and for bad.
Yes.
So you got to be on kind of Twitter to kind of see what's going to happen the next day these days. But anyway, the other one as well too is I've started to hear from a lot of clients is, is this all going to suddenly just drop off the shelf?
Yes.
And it's very hard to predict. I was, I think, 5 years or 6 years into the industry when the GFC happened. And, there was, in hindsight, there was a lot of economic indicators that indicated that there was some problems there. Yeah. You have a look at even the tech bubble and stuff like that.
Yes.
But right now, and this is not maybe just from myself, this is from many experts around.
Yes.
A lot of people are saying that if there is likely to be a sell-off, it's not going to be a catastrophe,
Right.
What's Morningstar's maybe view at the moment, or what's their positioning at the moment in regards to, the sell-off or a major crash? And we're not talking about corrections here. We're talking about major incidents like a GFC.
Yes. So let me take a small step back, because we were talking about Trump, trade wars, Brexit, US interest rates, obviously heightened geopolitical risk, which again has sort of fired up further in the last couple of days. The way that we're approaching this is to understand, are we getting a good deal in markets or not? Are they expensive? Are we being rewarded? And as I mentioned, generally speaking, we find that markets are quite expensive at the moment. And so the problem with that is that you have lower expected returns for the future, and you have a much greater risk of loss as assets return to their fair value, which is what we really think they're worth over time. And as you quite rightly say, often there's a catalyst in this situation that might cause a crash. Sometimes there's not. Sometimes assets can move to their fair value relatively slowly. And obviously sometimes there's periods not that long ago where we've seen, even Q4 last year, where we've seen quite sharp pullbacks in share markets. And the problem with this is that when markets are expensive, often what is driving that is effectively sentiment. And it's leading investors, they look at the strong returns that they've had and they think that that's reasonable and sustainable expectations going forward. And certainly in our view, that is not the case. And they have this fear of missing out. It's again, this human emotion that it feels like a good time to invest. Therefore, I don't want to miss out on those returns. Therefore, I'm going to pile in. without regard for the price that they're paying. Now, that is typically quite a destructive way to invest in terms of achieving longer term goals. And so when we are in this environment and we think the risk of loss is elevated, which we do at the moment, what that doesn't tell you is the timing and the catalyst for what might bring that back. And so we've touched on a few potential catalysts. We're talking about Brexit and other things. In fact, there's a heap of things that we could be talking about as potential catalysts. And indeed, it might not even be something that we're talking about yet. It might come onto the radar in the future. And it highlights that point that we cannot predict when this event, when markets might sell off. We don't know how sharp that sell-off is going to be. There is certainly a chance that we do have a very sharp correction, a GFC-like scenario, as you put it. But there's also a whole range of other possibilities that suggest that markets may weaken over time generally. And they're the probabilities that we're really trying to position for.
Do you find that obviously, even myself, it's very, very hard to predict a sharp downturn in the market. That's crystal ball stuff.
Yes.
But I have started to see maybe over the last 5 years that markets have become really sensitive.
Yes.
Really sensitive. If we talk about October to December last year, there was a 15 to 20% correction on most markets around the world.
Yes.
And, I'm finding the volatility, continuing to swing. And, I can't see that stopping. I can't see that with all this geopolitical risk happening at the moment. I can't believe that's stopping. So, I go back to my studies and I go back to my, all the things I've done over the years and sticking to the plan is kind of, sticking to the goals and understanding where the money is. And I think as well to clients as a tip is that these will always happen. You're going to have peaks and troughs. You're going to have cycles. You're going to have increased volatility. It's something that is going to happen all the time. Just at the moment, we're going through a very sensitive period, which may mean that there is a downswing. But, more often than not, they will come back. Yeah.
Yes.
And things may take a little bit longer than they once did, or they might take quickly than they did. So, I think engagement with us especially is important, and we've started to really increase that, Clint. We're, clients can see it. The engagement within us and the clients has increased more than ever, and we encourage that because there's a lot of news getting thrown out, and I think the media is creating a lot of this sensitivity. I think the president of the United States of America freely having a phone that he can tweet on every night, only go back, let's talk about, JFK or someone like that. I don't think that he would be out of the Oval Office sending tweets, locally, the Australian Prime Minister has now become a media face, for the Australian government. So, a lot of this sensitivity, I think, is also kind of blurring out as well what markets are happening.
I agree. And it's a lot of noise.
It is a lot of noise.
So the challenge for certainly us as investors and clients as well is to know how to navigate that noise, know when something is just generally noise or if it's something that you need to actually take notice of. And your comment around increased volatility is a true one. So in that weakness of the final quarter of 2018, the average portfolio saw losses that they have not seen for 7 years. So it was a significant event. But to be honest, the preceding period is more abnormal as well, in that we think that having few periods of losses, and when you get them, they haven't actually been that bad. That's not indicative of how, markets might work like that for a little while, particularly where there's central bank support, but it's not indicative of how markets should function over the longer term. And really what we're seeing is that if markets are, we would suggest that they are priced close for perfection. because investors, again, that sentiment has really driven up support for some of these markets. And when you have that situation where people feel like the good times are going to go on forever, the party never stops, that when you have one of these events like a Brexit or like a Trump that is front and centre with some quite uncertain news and potential outcomes, it really has the potential to rock the boat, because these people have overpaid for assets thinking it's going to go on forever. And that's really the environment that we think we're in at the moment. So again, we're not, we've no reason to think there's some sort of imminent or catastrophic decline, but we do think assets are generally overvalued. It means that firstly, we need to get quite specific around how we fill our portfolio with opportunities that we think are going to reward investors, and we can absolutely find them. We're happily invested where we are, but it also means that we need to hold much more cash. Cash is the primary way that we look to preserve portfolio values in overvalued markets, and it means that if some of these things do become better value, then we've got the cash in our wallet to go and buy.
Yeah, and I think that not just Morningstar, but some of the greatest investors of all time always have said cash is king. Always.
Of course.
And cash is king allows you to make investment decisions when you need to make investment decisions. And when something is completely undervalued, if you don't have the cash available, you can't buy. And I'm sure more clients out there that are listening to this or watching this will say, I wish I had X amount of dollars when this floated or when this was available.
That's right.
We as investors want to make sure and for clients that, cash is available to make these decisions. So,
and I think that's a key point of difference with our process, because we are valuation driven investors. As soon as we are not getting the required level of value, you're either starting to hold less of that asset, you're trying to, you might hold a slightly different asset, or you might come out of it altogether and just hold your cash until you are. Now that presents some challenges if you're looking at everyone else and they're all going, look, it feels like a great time to invest. Invariably, that is not a great time to invest. You never get the chance to buy good quality assets at a good price in good times.
So we've got this little internal message that says, if your mate told you that it was a good investment, don't buy.
That's right. It's always, and it's the taxi driver analogy where you get in and they want to talk, shares and things like that. It's that sort of media, that sort of sentiment that I guess happens on a much greater magnitude than that, obviously, that can really influence the direction of share and bond market. It's kind of like the tech bubble that you talked about. People were buying, and then at some point, someone and investors are looking under the hood going, actually, what is this worth? What are the cash flows that I'm going to get out of this asset? And then you compare that with the price that you've paid, and you realize, actually, I've got a really bad deal here. And this is the key. The best predictor of your future returns, and we've talked about a lot of stuff today, is the price you paid in the first place. Did you get a good deal? In which case you can expect those assets to reward you for years to come. Or did you pay too much? Did you get ripped off, if I could say it that way? In which case the risk of loss is significant.
And I think, mate, more than ever, Clint, it's a time where investors and clients need to be aware of what's going on. They can't just leave their money at will, and that's why a lot of our clients, I love working with them. They do put their trust in us, and we do partner with the likes of Morningstar as well to make sure that we provide them with that professional analysis and professional detail in regards to their money. And from our end, we've ramped up the level of what we do in the background. We have essentially like investment committee meetings every week in regards to what's happening in the world. On top of everything that kind of you guys do as well too. So, the client hopefully is sitting at home having a drink or a glass of wine and, having that team manage their money, which is quite important.
Yes.
So, Clint, I think I'm going to wrap it up. And I just want to say thank you very much for your time. It's always a pleasure to talk to you. We always have a good chat. And for clients out there, hopefully you got a lot of value out of this, and we've started to address some of the topics that you might be thinking in your head at home. Feel free to give us a call and give us a chat. None of the stuff that we've talked today is personal. This is all general topic, general in nature, and I will give you the opportunity to speak to you on your personal situation, because all of these things impact every individual different. You only have to go to a barbecue or grand final day and someone tell you something. That doesn't mean that it's applicable to you. So please feel free to give us a call. And if you have any questions, please shoot them through. I'll be more than happy to speak. So Clint, thank you very much for your time, and I really appreciate it.
Thank you, John, and thank you, listeners.
Thank you.
Bye.